You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it. You got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Boot Camp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, your Options Boot Camp drill instructors, Mark Longo and Dan Passarelli, will break it all down for you. Options Bootcamp is brought to you by tastytrade. Ready to shred your paper trades? Then trade at tastytrade, the broker that gives you what you need to make your own way. Get smarter every day with options education and research tools. Analyze your risks clearly with a potential profit and loss graph. Chart your way with hundreds of indicators. Make the numbers make sense and find the opportunities only you can see. Trade it with fewer clicks on an easy-to-use platform. Mobile, desktop, web. Supported by a trade desk with decades of combined experience. Stocks, options, futures, and more. You choose, you trade. Get what you need to make smart moves. Go to tastytrade.com/pod to see for yourself, genius. tastytrade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC. Fall in boot. It's time to get into peak options trading shape. It's time for Options Boot Camp.
All right, everybody. That music means we are back once again. Time to rock out on Education Wednesday with everyone's favorite. I hope it's your favorite. It's certainly my favorite. Options educational program. Yes, it is time once again for a little bit of the old Options Boot Camp, what the cool kids call OBC. My name, of course, Mark Longo, coming at you from the network which hopefully dominated your podcast charts back in 2024. I see the numbers. A lot of you listening. We thank you all out there for tuning in throughout the year, whatever you're doing, downloading, streaming, subscribing, rating, reviewing. All of it helps at the end of the day, helps drive the numbers, keep the folks happy, and of course, keeps new people discovering the content at the end of the day. So thanks to you. If you want to discover more, just like the winners of our 2024 Volatility Crystal Ball prize are going to, they won a free year of the Pro. Only one place to go, theoptionsinsider.com/pro. Congratulations to the winners there. That was an epic contest we had last year. 3 folks pretty much almost nailing a bullseye in VIX in the course of a year. That is impressive. Congrats to you. If you want to check out what they're going to get, head on over to the Pro, theoptionsinsider.com/pro, to kick the tires and light the fires as we welcome on our old pal, the black-hatted one himself, Mr. Dan Passarelli from Market Taker, mentoring what the cool kids call to Mr. P, welcome back to the show here, sir, as we're still kind of kicking off this wild new year, sir.
Yeah, that's crazy, man. But yeah, it's shaping up to be a pretty darn crazy year just here in the first 2 weeks of it, and doesn't look like it's going to stop the way I see it.
Nope, and the show's not going to stop as we head right on into a little bit of the old basic training.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Pull in, prepare to learn. Yes, sir.
All right, everybody, welcome to a little bit of basic training to kick off the new year. And as we're looking around the landscape, Dan was alluding to the fact that it is kind of a wild start to this new year, which if you listen to our end of year content, I did warn you. You said, in the last few years in particular, this market has really come in like a lion in early January. Hasn't been a sleepy time, and we are certainly living up to that right now. Wild intraday whipsaws, seemingly just a regular occurrence now. Multiple percent moves in the S&P. A lot going on. So, Dan, it seemed like a good time to do a little bit of a refresher on some important concepts when it comes to options trading. As we're kicking off the new year, we see the numbers, a lot of new folks joining the show all the time. So it seemed like a fun time, Dan, to review Skew. And not just because it rhymes, but because it rhymes adds a little bit of fun. What do you say?
Yeah, hey, Skew is always a good thing to talk about, my friend.
So let's start there, Dan. Let's play my favorite game. It's the Dan Passarelli word association game. When I say the term skew to you, sir, what leaps to mind?
Oh, man. It gives me a reminiscence of back when I was making markets and looking at volatility slopes, skew slopes, up slopes, down slopes. Now I think about term structure volatility, which I do a lot of work with our earnings trading. Oh, my gosh. I don't know. Was I just supposed to give one word?
You are allowed to give many, sir. It is allowed. But of course, the skew. What are we talking about? What do we mean? We throw this term around all the time. What the heck are we talking about, listeners? A lot of different definitions for this. If you go back to the primordial ooze days of the options market, the early 70s when the SIBO was kicked off and the options world was really, really taking shape into the 80s, all the primordial ooze days. Dan was 20 years into his career, but this was way before I got down to the trading floor down there. They used to draw out the volatility graph of a particular option. It was the chart that had your x-axis is your strike price, listeners. Your y-axis is your volatility. And there was an inflection point right in the middle there where the at-the-money strike was. And they would draw what was effectively known as the volatility smile. And that meant effectively they would just start from some high level on the left. It would curve down to the at-the-money was usually the nadir of the graph, somewhere close to the x-axis. And then it would curve up the other way, and it looked just like a smile. And everyone thought that's the way you map volatility. Volatility should increase in the wings, and the at-the-money should be the lowest. And then lo and behold, a data point came along called the 1987 crash. Again, before my time in the world of options, but I've talked to a lot of folks since then who were around in that time frame. And most folks point the finger at that event. That was the seminal moment. A lot of things happened in the 87 crash. First off, it wiped out a lot of firms, market making and otherwise. So the firms that were left standing in the 90s when Dan and I got into the world of options were the ones that survived 87, sometimes through luck. There were a lot of stories that my old backer at the time, Stafford, he just found a boatload of puts in the S&P in his back pocket they had forgotten about, and woohoo, good for you. Or sometimes with a little bit of skill, sometimes a little bit of both. But the firms that survived kind of made up what became some of the modern options market today. We have the Timber Hills and the Hulls that became the Goldmans. And of course, everything kind of evolved into the modern shape from the wreckage of that 87 crash. But one of the other things 87 did was, as many people say, it wiped the smile off the options market. All of a sudden, people started looking at the performance of options and that skew chart, which is supposed to predict options performance as you move up and down different strike prices. And they said, these two things, they're not really lining up. The skew chart, this smile is not really telling us what's going on. And lo and behold, this concept of our modern notion of skew was born. Dan, is that your interpretation of the origins of modern skew as well, sir?
Yeah, that 87 crash was a pretty pinnacle thing that gave a pretty good wake-up call to traders and made them understand some things that weren't understood prior to that, for sure.
So people started messing with that graph after the 87 crash, and they started pricing things out, and they started making a couple of realizations, especially let's start in the broad equity markets, because that's, of course, what experienced the crash the hardest, and, of course, where a lot of you hang your hats in the options world. They noticed a couple of things. They noticed that the volatility premium in those strikes below the at-the-money strike, aka what is known colloquially as the put wing in the Skew chart, they're kind of firm. They're kind of juicy. It seems like there's a bid for those a lot. And then also the strikes above the at-the-money strike, which are known as the call wing, they tend to be a little bit lower than what we see in the put wing, sometimes a lot lower. And a lot of things go into that, listeners, but that setup is called investment skew. That is what's known as investment skew. That setup where the implied volatility of the put wing is typically higher than the implied volatility of the call wing. Again, a lot of things go into that. Folks are usually just net long the market at the end of the day. So what positions are they putting on against that long underlying position? Well, they're going to sell calls against that. So that's going to depress the levels of implied volatility in the call wing. And then also they're going to buy puts to hedge. So what creates this skew, aka the name of what we're talking about here, this skewed volatility chart, is this level of activity. And again, prior to 1987, some people may have inherently thought that might have existed in the market, but there wasn't a lot of analysis being done to prove that. Post 87, people started looking at that saying, this is really how the options market tends to perform. And that skew chart is supposed to show you as you move along the strike prices, listeners, where your at-the-money implied volatility is supposed to be. That's how the chart's supposed to show you. As you go up in a lot of equity indexes and a lot of large indexes, that vol is going to come in. As you go down, it's going to increase. Obviously, you never really move exactly along that skew chart. Things are going to happen, especially if it's a abrupt, aggressive move in the underlying. You're going to gap around, and things are going to maybe move away from that skew line a little bit. But that is the inherent shape of most of the underlyings you're going to encounter, at least in the broad equity world. You get out into futures options and some of the commodity space, you might start encountering commodity skew, listeners, which is pretty much the polar opposite of investment skew. That's in a lot of underlyings where the interest, the concern, the fear is to the upside. And so as a result, you have assets like gold or a lot of the ags or other things where now you have the premium is to the call wing and there's not much demand to the put wing. You can see this if you go to a lot of precious metals, you can see this pretty much shaping up to various degrees all the time. You could see, again, sometimes certain ags exhibit this, then that kind of goes away. It's more of a temporary setup in the ags, whereas with a lot of the precious metals, it's more of a regular occurrence. So that type of setup, obviously good and attractive for things like collars because you can own the underlying sell and out of the money call pretty far away from the at the money for a decent amount of premium and buy pretty tight protection for not much outlay. So certain strategies shape up pretty well in those types of environments. Dan, anything else you want to add before we get into some more nuances of skew, sir?
Yeah. Well, I mean, not really. You covered most of it. I would say, like we always like to use these rules of thumb, and the rule of thumb is usually, hey, successfully lower strikes have successfully higher vol, and successfully higher strikes have successfully lower vol. Although the put vol increases at a higher rate the lower you go than the call vol decreases. But, like you pointed out, a good handful of some exceptions to that rule. And it's always important, I think, to know the rules of thumb, but also to look at every situation specifically. And when you see a non-volatility sneer, like you do with meme stocks or gold, like Mark said, and that kind of thing, I think it's important to ask yourself why and see if that makes sense. And then you can see if there's an opportunity there too.
Opportunities. Yes. So why are we talking about skew? Why is this important? In addition to being a fundamental aspect of the options market that you need to understand is going to impact your trading, it also will make certain strategies more attractive in certain environments, less attractive in others. I just talked about using collars in underlyings that exhibit commodity skew. That's very attractive for the reasons I just pointed out. But for a lot of you hanging out in the equities, you're going to be looking for opportunities to take advantage of, like Dan just pointed out, the meme stock skew is a great example. That's one of the reasons why we talked about that a lot when that was going on. And when it kind of reared its head a little bit again last year in certain names, it was worth pointing out and talking about on the show because it is such a different environment. All of a sudden you have that call wing that is usually depressed from a volatility perspective, now getting elevated. By the way, the standard metric, of course, for measuring skew is looking at the implied volatility of the 25 delta call, aka an out of the money call, and the implied volatility of the 25 delta put, and comparing the two. That's how you're going to see Skew quoted across a lot of platforms. Obviously, in most large equities and indexes, the put is going to be over from an implied volatility perspective, but just something to bear in mind as you're looking to compare and contrast Skew on different platforms. So obviously, if you're looking at strategies to take advantage of Skew, things that are going to be wide and cover a lot of strike prices are really where you're going to be looking. The quintessential Skew trade is the risk reversal. And Dan, to my knowledge, people have asked us a bunch of times on the network, where does that name risk reversal come from? To my knowledge, when I was introduced to this was done as strategy really for a lot of market makers, because as we trade a lot, listeners, you put on and develop a lot of Skew risk. In a large equity, a large index, what are you doing all the time? You're choking on calls because customers are doing nothing but selling you calls, and you can't find a put to save your life. All you do is sell puts all the time. So you have a lot of Skew risk in that position. So a position like a risk reversal, where you're selling an out of the money put and buying an out of the money call in a bullish risk reversal example, and flip that around in a bearish risk reversal, is an attempt to really reverse and take off and unwind some of your Skew risk. Dan, is that your perception of the origins of the risk reversal as well?
I mean, as far as the etymology goes, yeah, I don't know, maybe, I guess. I mean, interestingly, like different sections of the option trading world call it different things. Like in the commodity world, they might call it something else. It's been a long time since I traded commodity options, but I forget how they refer to that. But anyway, yeah, as far as the etymology goes, I don't know. I mean, I guess, that makes sense to me. Sure, why not?
Why not, indeed, listeners? A really quick overview of a example of a bullish risk reversal, XYZ, hanging out at 100. I saw somebody tweeting about people who talk about XYZ and options trading recently. It brought a smile to my face. Yeah, it's everyone's favorite / least favorite out there at the end of the day. We've all made and lost fortunes in XYZ, but XYZ's $100. You're looking at the setup. You say, you know what? I don't mind maybe buying some below the 95 strikes. I'm going to sell that 95 strike 1 month put. In our example, you get $1 for it. So obviously you're locked in below $94 effectively. And then you say, I think this thing's going to maybe run to the upside as well. I think maybe I'll play above, let's say 105 in our example. In our example, obviously, because Skew exists, that 105 call, not trading for $1, which it would be if you had that smile shape still in the markets to this day, where the wings are both treated equally. But no, in reality, we know the 105 call is going to be trading at a lower vol level than the 95 strike put. In our example, it's trading for 50 cents, exactly half of the value of that put. So what have you done now? You sold the 95 strike put for $1. You bought the 105 call for 50 cents. So obviously you have a net credit to this strategy for 50 cents. A couple of things. Obviously you've adjusted your break-even price. Now you're now in at 94 and a half for the options. And to the downside, of course, the put, you'll get the stock at an effective price of 94 and a half. And if the stock closes north of that 105 strike, guess what? You get to participate in all of that upside. So it's a great way if you don't want to. Some people we talk about straddles a lot on this, Ironfly certainly. Folks that want to play around with the at the money, you want to get a little bit of a bullish nibble maybe at the underlying, and also in our example take advantage of a little bit of Skew discrepancy. Then the bullish risk reversal is a great way to go about it. Dan, what are your thoughts on utilizing risk reversals to take advantage of different Skew setups, sir?
Yeah, I mean, well, it's one of those things that when we were on the trading floor, we would do a lot, just trading the Skew when it got, well, I'll just use the term I used back then, out of whack. Very scientific, professional term. But, I will say most retail traders, while I think you need to definitely understand the concept, you're not necessarily trading Skew like a trader's trading thousands of contracts to take advantage of very, very small changes in that. And, like the way that I used to do it on the trading floor is I would look at the downslope, which is how much volatility increases with successfully lower put strikes, and then the upslope, which was, the change in volatility among the higher strikes. And when it would get steeper or less steep in either way, I would look at that as, well, it should revert to the mean. Notwithstanding the fact that they all get steeper over time as we approach expiration. So, there's a ton of nuance to it. And if you have really deep pockets and you really understand volatility, you can take advantage of some of these very, very small changes. But, for a typical retail trader, it just I would say this skew, the strike skew that we're talking about, really benefits traders who trade vertical spreads under certain circumstances.
Yes, that leads perfectly to my next topic, listeners. We talked about just now an example where the call skew was trading at a discount to the put skew, which is, of course, the typical setup out there. But what we encountered last year and to a great degree in 2021 was kind of the opposite. When we started seeing in some of these smaller names, GameStop, SoundHound, I don't care, pick your name, some of the quantum computing names you saw at the end of last year, they all were trading at ridiculous premiums in the call wing compared to their historical norm, listener. So those are moments when you don't typically want to be buying those far out of the money calls unless you have some sort of hyperbolic move in the underlying, like we saw in some of those quantum computing names in the end of the year, in which case almost any strike you bought, you did all right. But outside of those aberrant scenarios, those are usually times when you want to take advantage of what the market is giving to you for free, listeners, and you want to take advantage of strategies that allow you to sell that extremely inflated call skew. So as Dan mentioned, wide vertical spreads are your friend in situations like that. Go back to the GameStop days of early 2021, or a lot of these hot names, the satellite names last year, SoundHound.ai. I can think of a million of them off the top of my head that have done this just over the past year, where they really allowed you to get into verticals. Remember, if that call wing is extremely bid, now you're selling that 25 delta call or maybe even lower delta, higher strike price call for a much higher level than you traditionally would, listeners. So that allows you to get into things like verticals, where maybe you're buying an at the money or slightly in the money or maybe slightly out of the money call, meteor call, and then selling a farther out of the money call against it. Again, you're able to buy that vertical typically for a much more attractive level because you're able to sell this strike that would have been garbage, that would have been worthless in the past, but now for a variety of reasons, overinflated hype expectations, people not understanding options, maybe all of the above, all getting rolled into that. Now you have these extreme levels of premium that you can take advantage of. So anything that allows you to sell that far out of the money of the call wing is going to be favorable for you, listener. So the vertical is the obvious choice. Maybe in the past, if you would have bought that traditional 50 delta versus 25 delta 1 month vertical in an XYZ name, maybe in the past it would have cost you $1. Now maybe you're going to get it for 50 cents, 60 cents, something like that. Or maybe even less, depending on how wild they bid up the call skew out there. You can also do things that allow you to sell multiples, like a butterfly maybe, as long as you're judicious in how you set it up. It's going to have to be a broken wing fly. You're going to have to stretch it out a little bit to really take advantage of selling the optimal strikes and then spread out your final buy, obviously, a little bit farther out as well, so you don't get caught buying too many overinflated options. But if you can structure it right, and sometimes you look at the strikes, listeners, and all the OI is really clustered around a couple of strikes, so that's going to cause even larger pivots around those strikes, so you could take advantage of selling those. So look at how the OI is setting up, look where the premiums are on different strikes, and that will help guide your strategy. If you want to go basic, straight covered call can also work. Obviously, you don't have to own the underlying then, so you have to be comfortable doing that, but then you could turn around and sell a covered call at levels you could never consider before, farther out of the money as well, and gives you a lot of room in case the underlying takes off. You still have a lot of room to run, and you're still collecting a lot of premium to do it. So these are all very high probability type trades that take advantage of that meme stock type skew and allow you to profit from setups that otherwise just wouldn't exist. Dan, any other thoughts for strategies and things you could do in these increasingly common meme stock skew environments, sir?
Well, I mean, the meme, I was thinking about it, like the meme stock thing is really just not a microcosm. It's kind of like the opposite of a microcosm. It's like a more extreme version of what just typically exists with the downside skew in a typical stock. Like it's the put skew is higher, and you have to ask why. And, this is an area where you probably really need a heavy math professor person to do a bunch of studies, and somebody who really knows what they're looking at too. Because you can kind of talk it through a little bit and say, well, there's more fear to the downside, so people pay more for it, which would imply that they're overpriced. But bigger moves tend to happen to the downside, and so some of that fear is maybe justifiable. And I think there is a little something in the math of the model that those lower strikes do end up producing higher volatility mathematically to get to the theoretical value. So anyway, that's just sort of the opposite with the meme stocks. Like, sure, like it's way overpriced volatility, but what if, what if you do get that short squeeze? You just get run over. So is it one of those things where you get what you pay for or not?
Some of those quantum computer names last year, they paid very quickly. And others, the money went to die. So it's kind of, you got to be judicious with that, listeners. But that is where you're going to encounter that the most. That said, Dan brought up the downside. We shouldn't ignore that as well. The puts are not immune to having inflated skew either, for a variety of reasons. You might see this in the broad index, for example, when things are getting, let's say, a little top heavy. Folks are starting to get a little skittish. They start bidding up the price of protection, usually also heading into major events. Could be a Fed announcement like the election last year, where we saw people starting to put on some hedges. They're concerned about what's going to happen immediately after the event. There's a lot of event risk. Those are times where you'll see inflated put skew. And you'll also see them in days when the market is falling out of bed. There's that old saying, buy the puts when you want them, not when you have to. And those days when you have to, when everything's on fire, the market is melting down around your ears, that's when you're going to see very inflated levels of put volatility. And if you're going to buy those, you're going to be caught paying up. So be judicious. Don't panic buy in a moment like that. Don't ignore the skew and the volatility levels that you're actually trading and end up putting on a put position that is impossible to pay off for you. We saw some of this in 2022. People early on in that year really overbuying on the put side, paying inflated levels of volatility for strikes that were just too far out of the money, and those puts went to die. Even though we did sell off in 2022, it was more of a gradual grinding sell-off, and so that really squeezed a lot of the juice out of those puts. So people ended up having a double whammy of loss that year. They lost on their underlying positions, and they also lost on the hedges that they bought to protect those underlying positions because they weren't cognizant of the skew and the volatility levels that they were trading. So there's your refresher on skew, listeners. Before 87, there was a smile in the options market. 87 came along, wiped that smile away. We now all realize that the options market, the volatility graph is skewed in most major indexes. It is skewed, obviously, in the juice favor of the puts. The calls, not so much. That said, that can change in some of these hot periods like the meme stock periods and others when the call wings get extremely bid. When those setups happen, you want to be judicious. You want to take advantage of it in a smart way if you are so inclined. Don't just go out there willy-nilly buying everything. Make sure you're paying attention to the skew levels that you are trading compared to the historical norms. You could see exactly how much maybe you are overpaying in that environment. And maybe if that's the case, maybe you want to take advantage of some strategies that let you participate to the upside, but also allow you to sell some of that overinflated vol at the same time. Then you can win on both sides. Listen, you could win if the underlying moves to the upside. You can also win if the vol comes crashing back to earth. So just something to bear in mind. Dan, any last thoughts you want to leave them with here on skew for this week?
It's one of those things that, like synthetics, for example, it's one of those things that like retail traders don't trade like professionals do, but you do end up with positions in them, and they do affect your profitability or your profit or loss. And so it is something that's really important to understand, because it gives you an extra edge. I mean, the more you learn, the more you earn, and you can't know everything about everything. But I'm glad we did this episode, because I think it's some really good food for thought for folks.
If you want to go deeper into Skew, listeners, you have more questions. We have hit on it a few times over the past year, listeners. Episode 309 from October 9th. We gave you some tips and tools for analyzing Skew. Luckily now, for a lot of the new entrants to the world of options, the tools are fantastic. You have access to things like volatility skew graphs and things that were really only the domain of professionals not too long ago. So you can listen to that episode. We give you some ideas and tips for different platforms and different ways to analyze and go about incorporating Skew into your trading. We talked about Put Skew again, episode 308, the week before that, October 2nd. We talked about crypto ETF options, semi-straddles, and Put Skew. And then we talked at the beginning of this year, or last year, I should say, February 21st, episode 277, when all this stuff was starting to get back on the radar. And was it time for the revenge of the meme stock Skew? We talked about that there as well in episode 275, where we talked about trading options in high skew environments. Just a few examples, listeners, of recent episodes you can go back to, let alone if you go back into the 10-plus year archives. A lot more going on about Skew there. We're just giving you a little bit of a starter, a little bit of a refresher, especially for a lot of those new folks hitting the feed right now. And Dan, for those new folks hitting the feed, if they want to hit a little MTM action, where should they go? What should they do?
Sure. Make your way on over to marketstaker.com. Market like stock market, taker like take what is rightfully yours, 2 T's in a row. Marketstaker.com, and join free. We've got some free classes, and you can join our chat room for free right now. And we'd love to hear from you.
And folks who want to hear from you include our friends over there at tastytrade. They are bringing you the show to kick off the new year. Check them out over there, tastytrade.com/podcast. Tell them we sent you. They will be very happy to hear from you. We'll probably have to get some of those folks back on. They always come armed with some funky strategies, jade lizards, and all kinds of weird stuff. So it might be fun to revisit all that fun as well. Speaking of revisiting things, if you're hanging out in the live, you got a treat today. We will be back instantaneously, listeners, in your ear holes with another hot episode of all things OBC. For the rest of you, we'll see you back here next week. Same bad time, same bad channel. Another episode of Options Bootcamp. Stay safe out there, everybody.
Options Bootcamp is brought to you by Tasty Trade. Ready to shred your paper trades? Then trade at Tasty Trade, the broker that gives you what you need to make your own way. Get smarter every day with options education and research tools. Analyze your risks clearly with a potential profit and loss graph. Chart your way with hundreds of indicators. Make the numbers make sense and find the opportunities only you can see. Trade it with fewer clicks on an easy-to-use platform. Mobile, desktop, web. Supported by a trade desk with decades of combined experience. Stocks, options, futures, and more. You choose, you trade. Get what you need to make smart moves. Go to tastytrade.com/pod to see for yourself, genius. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.